Hey everyone, Sherman the CPA here. Today I'm going to give you the 7 best Vanguard index funds to buy to build massive wealth. In a recent video, I covered the top 5 Vanguard ETFs, and since it helped so many people, I want to dedicate some more time to discuss Vanguard index funds, which is another way to buy similar funds. Like ETFs, these Vanguard index funds are low cost, extremely reliable, highly diversified, and have a strong track record of producing great returns. So if you want to learn more about what index funds are, why Vanguard is such a popular option, and most importantly, the 7 best index funds to buy, make sure you watch this video until the very end. All right, so what is an index fund? An index fund is a fund that tracks a specific index. Think of an index as a basket of different companies, and there are all types of different baskets. There are baskets of large companies, small companies, international companies, domestic companies, high growth companies, tech companies, and even baskets that include all companies. And inside of each one of these baskets, there are typically hundreds, if not thousands of different companies. Some of the largest companies in the basket take up more space, and since they do, they are assigned more of the weight in that basket. And if those companies become smaller in that basket, they'll take up less space, receive less weight, or even be removed from the basket altogether. If none of that makes sense, these are the top 3 reasons why index fund investing is so powerful. Number 1, index fund investing is completely passive. Because each fund automatically tracks an index, this means you do not have to actively manage your portfolio. Index funds are required to rebalance their holdings periodically, which means you don't have to worry about analyzing or adjusting your portfolio every single day. Because index funds are market cap weighted, your investments will always be shifted to the largest companies in each index. For example, Apple is the largest company in the S&P 500 index by market size. So it makes up 6.8% of the entire index to reflect that, whereas Gap, one of the smallest companies in the index, makes up 0.001% of the index's value. Number 2, index funds provide diversification. Because index funds include hundreds of companies, they provide more diversification than alternative investments. Diversification is important because it mitigates your risk over the long term. So instead of putting all of your eggs in one company or sector, you can spread yourself over multiple sectors in hundreds of different companies. And number 3, index funds have very low fees. Because index funds are designed to track indexes, it does not require the level of maintenance that actively managed funds require. This allows index funds to have extremely low fees. For example, Vanguard index funds are 65% less than the industry average for similar funds. So now that you understand why index funds are so great, let's go ahead and get into my list of the best Vanguard index funds to buy. Index fund number 1, Vanguard Growth Index Fund. This fund tracks the Spliced Growth Index, which invests primarily in large cap, high growth stocks in the US. It includes over 270 stocks, with over 50% of the stocks being concentrated in the tech sector, which makes sense given the rapid growth we've seen in the tech sector recently. For example, Apple makes up more than 11% of this entire fund alone, followed by Microsoft at 10.7%. So an investment in this fund would be heavily dependent on the largest growth stocks in the fund. Now, this fund has averaged a 10-year return of 19.29%, which is higher than the S&P 500 during the same period of time, and produced a 27.26% return in 2021. A $10,000 investment in this fund 10 years ago will be worth more than $58,000 as of the end of 2021. Now, on the other hand, in terms of dividends, its average dividend yield was 0.38% in 2021, which is the lowest dividend yield of all funds we will cover today. High growth stocks tend to focus more on capital appreciation than dividends. So in theory, your money will grow faster in value with growth stocks, but pay out less dividends than dividend stocks. Index fund number 2, Vanguard 500 Index Fund. This fund tracks the S&P 500 index, which means you will be investing in the 500 largest companies in the US if you buy this fund. And since 85% of active investors fail to beat the S&P 500 in the long haul, this means that you will be doing better than most investors by investing in this fund. Now, this fund has averaged a 16.5% annual return over the last 10 years and produced a 28% return in 2021 alone. A $10,000 investment in this fund 10 years ago will be worth $46,000 as of the end of 2021. It also has quarterly dividends, which normally yields around 1.2% per year. And it has a 0.04% expense ratio, which is next to nothing when compared to similar funds. Index fund number 3, Vanguard Total Stock Market Index Fund. This fund tracks the total US stock market, which includes small, medium, and large companies that represent nearly 100% of the US stock market. The inclusion of small and medium stocks adds an additional layer of diversification that many investors find attractive. This fund consists of over 4,000 stocks, which is over 3,000 more stocks than the S&P 500. It has averaged a 10-year return of 16.29% and produced a 25.72% return in 2021. A $10,000 investment in this fund 10 years ago will be worth about $45,000 as of the end of 2021. It has averaged a 1.14% dividend yield as of the end of 2021 as well. And it also has very low expense ratios like other Vanguard funds, coming in at just 0.04%. Now, despite the fact that this fund includes over 3,000 more stocks than the S&P 500, the makeup of this fund is highly similar to the Vanguard 500 due to market cap weighting. For example, the Vanguard 500 Index Fund that we just went over comprises 82% of the Vanguard Total Stock Market Index Fund. And this is because the largest companies in the Vanguard 500 are also the largest companies in the Vanguard Total Stock Market Index Fund. The only difference here is the addition of small and medium-sized companies, which represent a very small percentage of the total market. For this reason, most investors typically will choose one index fund over the other to avoid redundancy in their portfolios. Index fund number 4, Vanguard Dividend Appreciation Index Fund. This fund tracks the spliced U.S. Dividend Growers Index, which invests in companies that have a history of increasing dividends. This fund may be a great option for an investor who wants more income from their investments, even if that means lower appreciation in the stock's value over the long term. This fund includes high dividend stocks like Johnson & Johnson, Procter & Gamble, Home Depot, and over 260 more dividend stocks. This index has averaged a 10-year return of 14.52% and a 1-year return of 23.62% as of the end of 2021. A $10,000 investment invested 8 years ago would be worth over $27,000 as of the end of 2021. This fund has a 0.08% expense ratio and a 1.55% average dividend yield. So if you want more income from your investments, this may be a great option. Index fund number 5, Vanguard S&P Small Cap 600 Index Fund. This fund tracks the returns of the S&P 600 Small Cap Index, which represents 600 small U.S. companies. This fund is also market cap weighted like the other funds, but since 100% of the fund includes small companies, your investment would be weighted towards the largest of those smaller companies. For example, Macy's is the #1 holding in the fund, representing almost 1% of the total fund's value. This fund has averaged a 10-year return of 14.42% and produced a 26.67% return in 2021. A $10,000 investment in this fund 10 years ago would be worth over $38,000 as of the end of 2021. It has a 0.08% expense ratio, and its average dividend yields are about 1% on average. Now, one thing to keep in mind about small cap stocks is that they tend to be more volatile than large cap stocks, since small companies tend to be less stable and more likely to go out of business than large juggernauts. This adds a higher level of risk, but may also add higher returns. Vanguard rates this fund a 5 out of 5 in terms of risk, whereas the other funds covered so far were rated a 4 out of 5 in terms of risk. But if you want more exposure to the smaller side of the market to add some more diversification to your portfolio, this may be a great addition to it. Index fund number 6, Vanguard Real Estate Index Fund. This fund invests in 168 stocks that are issued by real estate investment trusts, which are just companies that purchase real estate like office buildings, multifamily apartments, single family homes, and so on. Real estate stocks may be great to add to your portfolio because it tends to have a lower correlation to the stock market than other stocks. So when most stocks in the market are down, there have been many times where real estate stocks were up and vice versa. Therefore, adding real estate to your portfolio can help diversify your portfolio and protect it from steep downturns. Now, this fund has averaged a 10-year return of 11.5% and produced a huge 40.38% return in 2021. A $10,000 investment in this fund 10 years ago will be worth about $30,000 as of the end of 2021. It has a 0.12% expense ratio, which is much lower than the 1.08% average for similar funds like this. And its average dividend yield are about 3 to 4% on average, which is much higher than all of the funds we've covered so far. This fund provides an easy way to passively invest in real estate without dealing with the day-to-day of tenants, toilets, and trash. Index fund number 7, Vanguard Total Bond Market Index Fund. Now, this fund invests in over 10,000 bonds, which are historically used to diversify the risk of stocks in a portfolio. Now, bonds typically are not very attractive from a capital appreciation perspective. When compared to US stocks, it performs nearly 5 times worse on average. So why would anyone buy bonds then? Well, bonds make more sense when you look at it from a risk perspective. When you look at the max drawdown between these two assets, you will see that US stocks drop more than 50% in one period of time compared to a 5% max drop in bonds during the same period of time. This means that if you invested $100,000 into each of these assets, your portfolio would have dropped to just $50,000 in US stocks or to $95,000 in US bonds. Now, this is a big deal, especially if you need the money you invest in the near future, whether it is for retirement or for an upcoming purchase. And that's why bonds are so beneficial. They are low-risk investments that can preserve your capital while providing you with reliable and consistent income. With that being said, let's go ahead and take a closer look at this fund. The Total Bond Market Index Fund is rated a 2 on Vanguard's scale of risk, which is the lowest risk profile we have covered so far. The portfolio is composed primarily of US government bonds and other bonds with extremely high credit quality, which is why the returns are so reliable. This fund has averaged a 10-year return of 2.85% and produced a small negative return in 2021 as we saw interest rates hit historical lows. A $10,000 investment in this fund 10 years ago will be worth over $13,000 as of the end of 2021. And the expense ratio on this fund is just 0.05%. Now, John Bogle, the founder of Vanguard, recommended that one's bond allocation should be equal to one's age. So if you are 60 years old, you would make bonds 60% of your portfolio and would invest the remainder in stocks or other assets. But at the end of the day, your asset allocation should be based off of your financial goals for the near or long-term future. A lot of younger people invest primarily in stocks because they are investing for the long term and have a very long time horizon. Whereas a lot of older people who are getting ready for retirement might start to convert some or a lot of their portfolio into bonds just to preserve their capital in the near term. Let me know what you think about this video in the comments below. And if you enjoyed this, make sure that you subscribe for even more videos that can help you increase your wealth. Thank you for watching.